Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish collective. Today we're going to talk about something different. We're going to talk about the market adjustment that we've just seen in the last couple of days, and it's still ongoing, right? I wasn't going to do this video so soon, and it's part of my commitment to the 11ish collective. I think it's more important for me to talk about it now and give you an idea of how I am adjusting my own portfolio. If this is the type of content you've been looking for, please hit that like button and let's get started. First and foremost, one of the key indicators that I use as a benchmark for all of the stock opportunities that I look at is the PE ratio. And if the PE ratio isn't there because they're losing money, generally speaking, then I look at the PS ratio. These two indicators tells me, beyond the business value, how optimistic are the current investors treating the stock. The PE ratio and the PS ratio is used to compare optimism against the market setters. So this way you get an idea of how optimistic the investors are looking at the stock you're looking at. For example, if the Microsoft stock is around 40, which most blue chip tech stocks are, then your stock is hovering around 500. That means that people are expecting explosive growth time and time again, every single quarter. Any form of bad news is going to send that stock tanking. So then at this point, you have to objectively ask yourself, are you trying to buy the stock because everyone else is buying it, or because you believe in the long-term growth strategy of the stock and you're okay with the fact that the stock might drop because the market is too optimistic? And because the market is too optimistic, a lot of these stocks did adjust. And with most adjustments these days in the marketplace, everything adjusts at the same time, which means that there are buying opportunities in my opinion. But at the same time, I would suggest that you wait till the adjustment as a whole finishes before you start averaging down or going back into the market. There are three additional theories that are being passed around these days about why this adjustment is happening. One is that the stimulus check isn't working as well as people think. And this idea is that most people don't actually need a stimulus check. There are plenty of people that are desperately needing a stimulus check, but a lot of people don't. And the consequence of that is a lot of them are gambling their money away. They're doing this by putting the money in the stock market via Robinhood or whatever platform you prefer, and they're playing options. This is inadvertently driving up the stock prices and causing these volatility that we're seeing after the COVID dip. The second possibility is that the interest rates are so low now, the legitimate institutional investors are looking for more ways, better ways to make money. And so instead of investing in bonds, they're now investing in equity. And this is causing an additional volatility, an additional optimism in the stock market, causing the drive up that we see, which will eventually cause an adjustment based on the indicators that they use. And then the third reason is that we have a set of people that thinks we're in a bubble. And I'm talking about real economists, like professors, think we're now in a bubble and we're just, any minute now, we're going to go into a crash. I think that we are in a bubble, but I don't think we're at the tip of the bubble yet. I think there's a set of stocks that are way too optimistic, and I got my ass trolled for saying Tesla is way overvalued. But I mean, NYU professors are saying this after I put out my video. I think that you guys should be very, very careful in terms of how you invest. And this is why in the comment section, when you guys ask me how I am investing or whether you should be doing X, Y, or Z, I always tell you guys, I do not think it's a good time to do options trading because the market is already volatile enough. The amount of gain you can get from a good investment opportunity is already high enough. If you start leveraging that, yeah, you're basically playing the lotto at that point, but the risk is way too high in my opinion. You're playing with money that you don't have a lot of the times, and that is a bad idea. The last thought I want to share with you guys is that I strongly believe a lot of the stimulus that we see, a lot of the propping up of the marketplace that we're feeling that is making the stock market grow, fueled by the fact that the Feds are printing more and more money. I strongly believe that a lot of this is driven by the fact that they want to have the best chances to win the election. Because it's pretty obvious, right? If the market tanks, everyone's going to blame the current administration and they'll have zero chance instead of some chances. Now, this is also why I am hypothesizing that soon after the election, regardless of who wins, the market is going to adjust and probably adjust very hard. The reason is that you cannot constantly print more money. That is just not sustainable. Inflation is already happening. The interest rates are already fajita. So my hypothesis is that the shit's gonna hit the fan soon after the election, maybe 1 or 2 months, hopefully not sooner than that. And I have full intention of adjusting my portfolio by then. Here's my PSA, right? So please take that with a grain of salt in terms of my ideas, my hypotheses, and what I'm gonna do with my own portfolio. The last thing I want to talk about in this video are the last 3 recommendations I made, right? So that would be DocuSign, Zoom, and Genius. For DocuSign, even though I wasn't expecting the Zoom-like growth opportunity, I still have quite a bit of money in it. Even though I'm down 13% at the time of me recording this video, because the fact that most analysts are increasing their price target to the high side is almost 50% higher than what it currently is, and it's below the current price target, and the fact that it is the market leader 6-7 times bigger than the nearest competitor, I strongly believe in this company's growth potential. I do not think that this stock is overvalued, and I'm going to hold on to it even through this painful stage. With Zoom, I even mentioned in my collecting win video that I expected a adjustment to occur. It just so happens that it adjusted way steeper than I thought. And because of the scale I play at, in any given day, I can be making or losing the amount of a Tesla. So I have to be very, very careful in terms of keeping my FOMO under control. And at this time, instead of exiting partially in Zoom, I've exited completely in Zoom. But I completely believe in every word I said in terms of business value and how we look in the future. So I absolutely expect myself to buy back in, hopefully soon. It's just the market is adjusting so hard, I have to be a little bit more cautious about my micro indicators. Also, there was an interesting thing about Zoom that I read. In terms of some analysts believe Zoom should have the market cap of AT&T and Verizon combined. I think going forward, way long term, that actually makes sense, right? Because why do we need phone numbers? I mean, I bet you don't even know half of the phone numbers from your own family, right? It's becoming more and more irrelevant. And so therefore, it makes sense that, video conferencing becomes just regular phone market cap. And lastly, with Genius, I mean, my personal experience with economic adjustments and depressions and bubbles in general is that penny stocks, they either go bankrupt or they're immune to it. And because Genius has so much money behind it, because of the dilution they just did, and the type of leadership and the experience behind the team, I'm going to continue to hold on to that. I actually averaged down after the Zoom play, and so now I have about 20 grand into the stock. And again, I plan on holding on. My thought process behind that is still sometime next year is when I expect payoff, or if they fuck up their roadmap. For the rest of my portfolio, I'm holding a shit ton of gold, a shit ton of silver. I am holding quite a bit of Lockheed Martin because I think that in itself has a lot of growth potential still, especially when you see more and more government contracts around it. You see that, I mean, in my opinion, the globe is kind of in an unrest state, and so governmental contracts around Department of Defense is more important. That's the play I'm doing. Everything else is pretty much the same. So hopefully everything I said makes sense to you. If you have any questions or concerns, please leave me a note, and if you have any requests, spank that subscribe button for me and then leave me a comment as well. I'll definitely hit you up. Thanks for watching, stay safe, and I look forward to working with you next time. Thank you.